The fact is that GAAP earnings, which so many people seem to like, lost their relevance in recent decades. They no longer reflect performance of companies or change in the values of companies. And the reason is that expenses today are a hodgepodge of true expenses like salaries, rent, interest, and investments in the most important resources of the companies, like customer acquisition cost and R&D and IT and human resources. So the net result earnings don't really reflect changes in values. In the old days, earnings did that. Earnings were just the difference between revenues and true expenses. At that time, companies mainly invested in property, plant, equipment. These investments were capitalized, so they were not in the income statement except for depreciation. So earnings really reflected value. Today, they don't. Now, not only do earnings reflect the most important investments of companies, they also include lots of one-time items due to adjustments of assets and liabilities, impairments of assets, impairments of goodwill. So the end result really doesn't reflect sustainable earnings of companies, the performance of companies. And the proof of this is that the relationship between reported earnings, GAAP earnings, and stock prices plummeted over the last 20, 30 years. So the reason for the huge increase in non-GAAP earnings, and not just in non-GAAP earnings, in non-GAAP reporting in general, like pipeline of drug companies, is that GAAP earnings lost their relevance.